Hi, I'm Marcel with Guaranteed Rate, and I wanted to give you a quick update as to what is going on with the market. Obviously, there's a tremendous amount of volatility that's going on, both with the equity markets as well as mortgage bonds, the way that they're trading, 10-year bonds, and the overall global perspective. So just wanted to give you some information. So last night, which is going to be Sunday, March 15th, the Fed actually had an emergency meeting in order to lower the Fed funds rate. Now, they lowered it to a target of 0% to 0.25%. That doesn't necessarily mean that mortgage rates have dropped. In fact, the Fed funds rate is the interest rate at which banks can borrow money from one another. So the reason that was done was in order to increase liquidity and lessen the likelihood of there being any type of financial freeze in the system. The other indice to look at that generally does have a pretty good correlation with 30-year mortgage rates is the 10-year bond. Now, I can tell you that the disconnect has grown greater in the past 2 weeks than I've ever seen it between the 10-year bond and the 30-year mortgage interest rate. I want to share a chart with you real quick, and what you'll see is that right now the disconnect between the 10-year bond and 30-year mortgage rates is huge. There's a massive disconnect. And so the question would be, if the 10-year is so low, why is it that mortgage interest rates are still going up, when in fact they should be much lower than they are right now? Well, there's actually 3 reasons why mortgage interest rates are higher. Reason number 1 is going to be capacity. Right now, lenders are struggling to keep up with capacity. If you look at the entire mortgage market in 2019, roughly a little over $2 trillion in mortgage volume was done just last year. And last year was really a historic year. We had an awesome year last year. There was lots of people that were actually going out and buying, and a few people refinancing homes, but it was primarily just purchase transactions. So if you look at how much volume the industry is structured to be able to handle, in essence, you're talking about roughly $2 trillion. If you look at how many loans are outstanding in the United States right now, you're in essence looking at a little over $11 trillion, of which $7 trillion or more are going to be eligible for a refinance. So all of these people now are starting to look at their interest rates. They see everything on the news. They see all of this information that says that they may be able to lower their interest rates. So a lot of them are actually reaching out to their lenders and asking, what are we going to be able to get if we were looking at doing a refinance right now? So just imagine if you as a business can handle $2 trillion of volume on an annual basis. And then over a 1 week or 2 week time frame, you have, let's say, $4 trillion, $5 trillion knocking at your door saying, can we go ahead and get refinanced? The industry just isn't set up for that. And so what mortgage companies have done in order to kind of curb that demand a little bit is by actually increasing interest rates. When they should be going down, mortgage companies are increasing those interest rates because literally they don't have the capacity to handle that. Almost consider the analogy or an example of a car. Let's say you have a car and it is set to handle RPMs of 7,000. What if all of a sudden you wanted that car to basically run at RPMs of 27,000? The engine would blow. And so that's kind of the same thing that's happening in the mortgage industry. So the way that demand is kind of slowed down a little bit is mortgage companies are artificially increasing their interest rates in order to slow that demand because of capacity. Next, let's talk about liquidity. Liquidity is something that a lot of people aren't aware of because they don't understand some of the inner workings on mortgage companies. What generally happens when a mortgage is created, in essence, that money is loaned out. It goes out to the title company and then it sits on the books. The way that it's removed from the books then is it's sold through a warehouse line to a mortgage servicer or Fannie Mae and Freddie Mac. In essence, if you have that money sitting on your books, you can't loan that money out again because in essence, it is already tied to a specific mortgage. So what mortgage companies do is they tie those servicing rights and that mortgage, they pass that along, and then they replenish their funds so that they can actually go out and write more loans. Well, what's happening right now, because there's such a huge influx of volume, literally it was looking like things were starting to freeze up a little bit. Mortgage companies were not able to get these loans off their books. If they're not able to get the loans off their books, then they don't have money in order to write new loans. So with that, when you're looking at the back end and you're looking at liquidity, that was starting to freeze up. Now the good news is that the Fed actually came in and said that they were going to purchase $200 to $500 billion in mortgage-backed securities. That should ease up the liquidity factor a little bit, but don't forget that right now capacity is still an issue as well, which in the short term could end up keeping interest rates higher than they should be. The other thing to think about is mortgage companies right now are actually bleeding money. You would say, well, if everything is so good and there's so much volume, why is it that mortgage companies are bleeding money? Well, you have to remember that a lot of these loans, whenever these loans are made, they're not profitable from day one. In essence, most mortgage companies are going to end up making their profits by holding a loan or servicing a loan, typically, let's say 5 years, 6 years, 7 years at a given interest rate. So what they'll do is they'll actually have what's called a servicing release premium. They pay out to the mortgage company that originated the loan a certain amount of money, knowing that they're going to recoup that over the next 5 years, 6 years, 7 years. Well, what's happening in the market right now is there were a lot of loans that were originated in 2019. The assumption at that point was, hey, these loans at 4%, they're going to end up sitting on the books for quite some time because that's what people do. Generally, they don't move all the time. However, what's happening right now is that these loans are actually not on the books even a year. So there is a tremendous amount of loss from that servicing release premium. So mortgage companies are really bleeding money there. Also, right now, mortgage companies are paying everyone overtime. They're having to hire additional staff. That ends up being expensive. So overall, mortgage companies are really just trying to stay afloat right now. They're trying to manage capacity. They're trying to manage liquidity. They're trying to manage their servicing. It is really a very, very unique and historic situation in the lending industry, and all of this has yielded slightly then higher interest rates. Now keep in mind, interest rates are still great. You're talking about interest rates in the high 3s, low 4s. Those are still great interest rates, but they are artificially inflated in order to curb that capacity, in order to help with the liquidity, also to help with the servicing. Now, in my opinion, interest rates are going to end up coming back down, but it may not be today, it may not be this week, it may not be this month, but interest rates are going to end up edging back down slowly as lenders start to get a handle of this capacity, as some of the liquidity issues and servicing issues start to get worked out. So here is my advice if you are thinking about buying a home. Great news is right now, because interest rates are very, very good, and there is certainly some fear out there, the likelihood of you having multiple offers on a house actually went down. And so that means it's a great time. Interest rates are great, and if you have less people that are actually looking at homes, and you have less of a likelihood of being in a multiple offer situation, it means that you're probably going to have a better chance at getting the home that you actually want. So in that circumstance, it certainly is a great time to take advantage of some of these low interest rates. The other thing to think about is right now the mortgage industry needs your help. More cooperation than the mortgage industry has ever seen when it comes to documentation. I can tell you, after having been in the business since 1998, there is a delayed perception of need for documentation, meaning the mortgage company asks for documentation. Normally it's okay if you get it to them in the next 5 days, 10 days. That's all okay. Right now, because of capacity, you really want to make sure that you cooperate with the mortgage company on the highest level and turn in all of your documentation as quickly as possible. Remember, literally, they have so many people that are all trying to get on the bus at the exact same time that the ones that are going to be served first are the ones that are going to be most cooperative, the ones that are turning in their documentation, because there's certain documentation that has hard stops on it, meaning that if this documentation doesn't turn in, you don't go to the next milestone in the mortgage process. So if you're buying a home, make sure that your cooperation is extremely high, and your mortgage company and mortgage loan officer and team will make sure that things go smoothly for you. If you're thinking about refinancing, here's what I would suggest. Get all of your documentation together as well. There are some options on refinances to not even need an appraisal, for example. And so make sure that when you are talking to mortgage companies, if you decide to move forward and truly do move forward. There's so many people that are out there right now, and they may be shopping mortgage companies, telling people, right now I'm looking at 2 or 3 or 4 different mortgage companies. If you are in a position to where you can take advantage and have benefit of the interest rate, go ahead and move forward, because again, right now what mortgage companies are doing is they are serving the people who are being most cooperative, who are providing that documentation, which allows them to move past that hard stop. Again, I know times right now are very, very crazy. And so if there's anything that I can answer for you or do for you, please let me know. I'm Marcel with Guaranteed Rate. Best number to reach me is 972-672-3246, and I hope you have a great day. Thanks.